This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Weekend watch, a critical few days ahead for investors as Washington tries to end the standoff. There's no deal yet. We'll tell you what the market pros are doing ahead of Monday's opening bell.
$2 trillion. That's the hit the nation's retirement savings could take if no deal is reached and the U.S. defaults. So what can you do to lessen the risk?
And bank on the banks. The financial sector makes up a large portion of the U.S. economy. But are the big banks a good place for your investment dollars now? A top bank analyst gives his view and names names. All that and more tonight on Nightly Business Report for Friday, October 11th.
Good evening, everyone. Lawmakers are talking in Washington, and on Wall Street, stocks are rallying. More strong gains in the markets today on renewed signs of optimism that Congress and the White House are working on a compromise deal to extend the nation's borrowing limit and to begin negotiating a resolution to reopen the government and get furloughed workers back on the job. To be clear, though, there is no deal yet, and large parts of the government are still shut down. But Democrats and Republicans are at least talking for a second consecutive day, giving the markets hope that a solution is closer at hand. Eamon Javers joins us now from Washington with the latest. So, Eamon, how close do you think we are to some kind of a deal, maybe by Monday?
Well, Monday might be a good target day to start looking at here. And there's a lot of movement here in Washington, but it's not exactly clear where we're going. We began the day with Senate Republicans going to the White House to meet with President Barack Obama, including Ted Cruz, the president's chief antagonist in all of this. He was in that meeting today. We didn't get a readout from the White House on what happened inside that meeting. Later in the day, we know that the president called the Speaker of the House, John Boehner, for conversation. We didn't get a readout on that one either. And then we saw that throughout the day, the White House continued to postpone its typical daily press briefing hour after hour after hour. We finally got that briefing late in the day, and the White House didn't say all that much either. That's generally a good sign. When they're actually negotiating, they don't say a lot. When it's total stalemate, that's when they come out to the microphones and denounce each other. We did not see that today, so maybe an encouraging dynamic here in Washington.
You just answered my question. I was going to ask you whether we should infer anything from the fact that it was a pretty silent day on Washington. What would be the timeline of a deal or a framework for a deal over the next few days? What could we expect?
We know that the House of Representatives is coming in tomorrow. They'll be here at 9 a.m. Congressmen hate to work weekends, so they're going to want to work this one as quickly as possible. And, of course, we know the deadline is Thursday next week. That's the day that Treasury has said that it's going to run out of money and we're going to hit the debt ceiling limit. So presumably some point between Monday and Thursday is the sweet spot for getting a deal done here if they're going to get one. And it looks like, all the dynamic is that they are actually talking to one another, although the White House is bending over backwards to avoid saying that they're negotiating because, of course, the president had promised he wasn't going to negotiate. But nonetheless, he was in a room with Republicans talking about something today. Whether it was a negotiation or not, that's up to you to decide.
Eamon, what do you think about the impact of these Wall Street rallies are having on the negotiations? We've had two back-to-back days of triple-digit gains on the Dow. To what extent is that giving them the feeling that they've got to come up with a deal? Because it's going to look bad if on Monday and Tuesday we have big sell-offs.
Yeah, I had a chance to ask a United States senator about that yesterday as we saw that mega rally on Wall Street. And he said that the senators are watching that as they, go through their deliberations. But, it might not be enough to change the minds of those people who are pretty much set on a course of action. So they're paying attention. They're feeling the push from Wall Street. But it might not be enough to make them change their minds if they already feel very strongly. These are very core political values that are being debated right here.
All right, Eamon Javers just north of the Capitol for us tonight. Have a great weekend. Well, the fact that there were no negative headlines out of Washington kept stocks in rally mode today. In fact, the gains today, combined with yesterday's, made for the best two-day return for the Dow, NASDAQ, and S&P since January. The Dow and S&P both scored gains for the week, up about 1%, but NASDAQ finished a week with a loss, less than 1%, for the first time in the past 6 weeks. Today, just one day after its largest point increase in nearly 2 years, the Dow closed at the high of the session, up 111. The NASDAQ was up 31, and the S&P gained 10.
So what do you do with your portfolio while Congress still tries to hammer out a debt deal? We'll tell you what some market pros are doing. That's coming up a little later in the program.
Well, the markets move on data, of course, and today the U.S. Energy Information Administration announced that it won't publish its weekly crude and gasoline inventory levels, along with other data, until its government funding is restored. The agency asked energy companies to continue submitting their figures to the EIA, which will be processed after furloughed workers return.
One well-known corporate executive is fed up with the deadlock in Washington, and he's urging his customers to do something about it. Starbucks CEO Howard Schultz is asking customers to sign a petition directed at Congress and the president inside his coffee shops over the next 3 days. He's also taken out full-page ads in major newspapers that readers can bring in to Starbucks stores. Schultz explained his frustration over the budget impasse and what it means for businesses and for the U.S.
The polarization in Washington is affecting our standing in the world, consumer confidence, consumer behavior. Small and large businesses across the country are going to be affected dramatically. And this is no way to run a country.
So how concerned are you about the debt ceiling and the government shutdown? We went outside and tried to find out.
What I'm most concerned about is that the government is not functioning right now.
I'm concerned about the stock market. I'm concerned about banking.
We see politicians which they don't care about us, they care about agendas.
The whole damn thing is a joke. A bunch of crooks trying to con us out of the little bit of money we make.
They spent the money, you have to pay your bills.
I just think they got to do their job, and they're not serving our population.
Well, a top Federal Reserve official is doing his job by defending the central bank's decision to maintain its massive stimulus plans instead of tapering back those measures. Speaking in New York today, Eric Rosengren, he's the president of the Boston Federal Reserve Bank, said that the decision not to pull back on bond buying was fully warranted because of weak economic data and a steady rise in interest rates.
Well, two of the nation's biggest banks reported their third quarter results today. The numbers are closely watched, in part because the financials are the second biggest component of the S&P 500. The Dow component, J.P. Morgan, posted its first loss ever under CEO Jamie Dimon. It lost $380 million as the bank set aside more than $9 billion to cover legal costs. Strip out those charges, and the bank actually beat Wall Street predictions with a profit of $1.42 a share, or $5.8 billion. Wells Fargo also posted a profit, 99 cents a share, or $5.6 billion. That was 2 cents ahead of expectations. Here with more analysis on the banks is Brad Hintz, equity research analyst at Sanford C. Bernstein. Mr. Hintz, welcome. Good to see you. Let's talk a little bit here, if we might, about J.P. Morgan. $9.2 billion charge in this quarter. The company told the market that they have $23 billion in total legal reserves, and it's possible that they could exceed that amount by nearly $7 billion. That's stunning, isn't it?
Well, I think what you have here is a bank that is attempting to tell the market we're well reserved. This, the $9 billion we put away today puts us in a good position for whatever could happen going forward. And it's really trying to settle with the government. You could hear it from the tonality that in terms of how the CEO spoke. When asked about regulation, he said, we will comply. So to me, this is J.P. Morgan saying, let's negotiate, let's get this behind us. And that's really one of the positives on JPM. JPM has actually underperformed, if you look at relative to the other banks, over the last 6 months or so. A lot of this is the regulatory overhang. So, what JPM's management is doing is saying, here's the number, analysts. You don't have to worry about it now.
All right. So really two related questions. First, on J.P. Morgan, are you recommending the stock? Would you buy it at 52?
I think the issue, we haven't outperformed on JPM. To me, from a timing point of view, the issue is this is a stock that will do extremely well once the settlement is behind it. Okay. The overhang of the regulatory charges, the concern about them from a litigation point of view, has really pushed down this stock. This is a leading investment bank in a recovering economy. So, extremely well-run place.
What I wanted to ask you, Brad, the follow-up on that is that this conversation around J.P. Morgan reminds me a lot about all the litigation problems that were going on with Bank of America, even just recently, and people were fleeing from that stock. So is J.P. Morgan still a buy, or is Bank of America a better one? Because its legal problems are pretty much behind it.
JPM has certainly been hurt worse. So it strikes me as JPM, and actually the analogy that I would use is Goldman Sachs. Both JPM and Goldman Sachs were really the leading banks, and as the leading banks, unfortunately, you're the one who gets shot at by the regulators. In terms of regulation, the issue here is to make sure that Wall Street finds out who's in control. And that's very much what's going on here. Yes, there were problems in terms of the mortgage-backed business, but JPM, the well-run firm, is the one that's being focused here.
Talk to us a little bit about the changing sort of environment in which banks are doing business today. Interest rates have been rising. The other bank that came out with its numbers today, Wells Fargo, the largest mortgage originator, but taken with Chase, the two largest. How is that changing their business? And when you look into their segments, fixed income, commodities and currencies, that wasn't doing all that well. Trading wasn't doing all that well. Investment banking wasn't doing all that well. Are we looking at a changing environment for the big banks?
Well, certainly on the trading side you are. On the trading side, what you're seeing is less risk, more capital. That brings the ROEs of the businesses down. Higher, a much tighter risk management culture. This slows down decision making. Now, we are in a transition stage, and that transition stage is we're trying to learn how to live in that environment. And what will happen is bid-offer spreads will open up. In other words, the cost of doing trades will become more expensive. The markets will become somewhat less liquid. The street will learn to operate with less capital. But this transition phase means that you're generating relatively low returns on the trading business. There are only two banks in the world that are beating their cost of capital in terms of trading. That's Goldman Sachs and JPM. The rest are still in this learning stage, and it could be 18 months.
Very interesting time for the banks. Mr. Hintz, thank you very much.
Pleasure.
Brad Hintz is equity research analyst at Sanford C. Bernstein.
And still ahead on the program, how could a U.S. debt default impact your retirement nest egg? Coming up, we'll have the answer and how you can protect yourself. But first, how the international markets closed today. Some good news for a change for Motor City. Barclays Bank will provide the cash-strapped city of Detroit with up to $350 million. It's earmarked the financing to help Detroit's state-appointed emergency manager make investments in infrastructure and end some interest rate swaps at a discount.
Long wait times, error messages, and technical glitches have stymied millions of Americans from shopping for new health insurance plans on healthcare.gov, the federally run online exchange, part of the Affordable Care Act. And now experts say the administration has little more than 1 month to fix those technical woes or risk jeopardizing the goal of signing up millions of Americans in the 36 states that don't offer their own online marketplaces.
Well, we've been reporting all week about the impact of the Washington stalemate on the markets, the economy, and American businesses. But here's another worry, your retirement savings. Even though lawmakers are negotiating to reach a deal to avert a U.S. debt default, new figures show the staggering toll a default would take on retirement savings accounts. Sharon Epperson has more on the sobering figures.
Jill Hagan, who is in her 50s, assumed she would work for another 10 years. Now the fight in Washington over the U.S. debt has this New Jersey podiatrist worried that retirement could be decades away.
It concerns me that when I retire that I may not have enough money in my retirement fund to live the life that I've been living, mainly because who knows what's going to happen with the government in debt and with deficits.
Even if lawmakers come to a short-term agreement on the United States borrowing limit, many investors like Hagan, troubled by the ongoing debt debate, fear that it could have a devastating impact on the economy, financial markets, and their retirement savings.
I'm not investing now because of the situation we're in, and I'm just on hold with my investments.
We don't really feel like we need to make more money. We just like to not lose the money we currently have.
Yeah, I'm concerned. You pay all your money, you hope one day to be able to see the benefits of all the money that you contributed.
There is reason to be concerned. According to a new report from the American Society of Pension Professionals and Actuaries, private pension assets, including 401ks and IRAs, could suffer losses in excess of 20%. That's over $2.4 trillion. They base this assertion on what happened in 2011. That summer, the Federal Reserve's second asset purchase program expired. The U.S. debt negotiations went to the 11th hour, and just days after the debt limit was raised, the United States credit rating was downgraded. There was immediate sell-off, and the S&P 500 plunged 17% and took nearly 7 months to recover. While most investors follow stock market performance, if a deal isn't reached soon, interest rates could spike, and the value of bonds, considered a safer investment, may plunge. That's a major worry for retirees and baby boomers nearing retirement, who are counting on stability and a steady stream of income.
Most of my patients tell me when I sit and talk to them that they're not going to be able to retire because they didn't have the savings and they didn't have the retirement funds.
For now, some financial advisors suggest shifting some assets to short-term bonds and cash. Others advise adding alternative investments to help weather the storm. While some investors may see a significant short-term slide in retirement savings, most advisors say account balances should recover over time. For Nightly Business Report, I'm Sharon Epperson.
Two major drug companies get downgraded, and that is where we begin tonight's market focus. Jefferies cutting Merck to a hold and Eli Lilly to underperform from buy. The firm says Merck's cost-cutting efforts have been less than hoped for and that Eli Lilly's research and development pipeline is weak. Both stocks down on this up day. Merck off less than 1% to $47.29. Eli Lilly off fractionally to $48.88. Micron Technology getting hit after reporting earnings below estimates. One analyst says the company's guidance is not as great as some had hoped and that the near-term supply-demand balance is less favorable. Another analyst downgraded the stock to underperform from market perform, citing the valuation there. Now, don't lose sight of the fact that Micron shares have soared 165% this year, but they did fall more than 8% today to $16.84.
Safeway was the best performing stock on the S&P 500 today, and that's despite reporting earnings below analyst estimates. Investors instead focused on the supermarket chain's strong revenues and its plan to exit the Chicago market, something an activist investor has been pushing the company to do. The stock ran up almost 7% to $33.75. A warning today from Silicon Graphics slammed its stock. The company said its earnings could come in below analyst estimates because some of its IT projects that are funded by the government have been put on hold. Silicon Graphics provides computer servers to large-scale data centers, and some of its biggest names in tech include Facebook and Yahoo. Shares plunged more than 9% on the news to $14.75. And Solar City soaring today on a sunny forecast. It expects installation of its rooftop solar panels to rise about 90% next year. The company allows homeowners to lease solar panels, and that means a very small upfront cost to customers. The stock rose 23% to $47.18. Well, our market monitor tonight says his stock-picking strategy has less to do with the skirmishes going on in Washington and more to do with the fundamentals of individual companies. So far, that strategy seems to be working for him. The fund he manages, the Chase Mid-Cap Growth Fund, is up more than 25% this year. Joining us now, Brian Lavorshak. He's portfolio manager with Chase Investment Consult. Brian, nice to have you back on the program. I want to ask you a little bit about your strategy. Are you saying that these triple-digit gains that we've been getting on the Dow, or if we get big, sharp declines next week, you're not paying attention to them? It's just sort of noise in the background and you're going about business as usual?
Thanks for having me, Susie. I wouldn't say we're not paying attention to them. However, we're trying to lean against some of that volatility a little. You've certainly seen volatility over the last couple of weeks, both to the downside previously and then the upside over the last couple of days. And for the most part, we're trying to use that as opportunity to either add to positions we like in our portfolio or sometimes on those good days take a little bit off the table.
Brian, nice to have a stock picker from my home state of Virginia, first off. Why don't we just get to some of your picks here, because that's what people really want to know. And your first one is Harley-Davidson. They'd had a rough patch, but I guess they're coming back.
Sure, Tyler. It's Harley-Davidson is a very long-term. People have always thought of it as a growth company. But as you said, they went through a difficult couple of years, really seem to be getting things back on track. And one of the things we favor in our process is earnings momentum. And to use a little bit of a pun, earnings are really accelerating for Harley-Davidson right now. They really have some strong improvements for the 2014 model year. People are getting excited about, and we think that has a pretty good future going forward.
Your next pick is a ticker symbol JAH. This is Jarden Corporation. People might not know what this is, but they know the brands, right?
Yeah, Susie, Jarden is a conglomerate of household brands. So while most people don't know Jarden, everybody's heard of some of their brands like Coleman and Crock-Pot, Rawlings Sporting Goods, K2 Skis. And recently the company acquired Yankee Candle as a rather significant acquisition for them. It's going to push earnings this year on top of what were already a good earnings profile. So we're looking at a company that's growing in the teens and is trading for about 12 times next year's earnings. Pretty attractive valuation to us.
And you like Dollar Tree?
Yeah, Dollar Tree is kind of the classic conservative growth and consistency of growth story. That's one of the things we really favor in our process. Dollar Tree really grew earnings through the last 2 recessions without a hiccup. Certainly the stock can underperform some of the more exciting peers when people get really excited about the market, but it is a very good long-term story and we like it here.
One thing I'm noticing with all of these stock picks that you're giving us, Brian, is that they've really had a great run-up over the past year. I don't know if there's still upside, so address that, but also tell us about your last pick, Euronet Worldwide, EEFT, and this one trades on the NASDAQ.
Yeah, and of those, Euronet Worldwide over the last year or so has been the best performer. Actually, that good performance is something we look for in our process. We favor strong relative price performance, but at the same time, we pay attention to valuation. So a stock like Euronet can do quite well, but as long as the earnings power is good and earnings continue to grow, we'll still invest in it. Euronet is in several businesses. They operate ATM networks in Europe. They do gift cards and prepaid phone cards as well as money transfer. So a really interesting collection of businesses and a good investment opportunity to our eye.
All right, all sounds good. Any disclosures to make, Brian?
Own all 4 of those stocks through my holdings of the Chase Midcap Growth Fund.
All right, thank you so much. Have a great weekend. Brian Lazorczak, sorry about that, Brian, with Chase Investment Counsel.
And still ahead, investors will be focused on this weekend's debt talks, of course, so we will get some advice from market pros about what could happen next week and what to do to get ready for it. But first, how commodities, treasuries, and currencies performed today.
Gold lost a bit of its luster today, falling more than 2% in value and closing at a 3-month low, $1,268 an ounce. Investors cashed out of the safe haven heavy metal today as lawmakers appear closer to reaching a deal on the debt ceiling. Sharp declines early in the trading session forced a 10-second halt in gold trading to prevent what NYMEX officials called, quote, excessive price volatility. Tyler?
And, Susie, while members of Congress and the White House plan to work through the weekend hammering out a deal to raise the debt limit, investors may want to use the weekend to prepare their portfolios for whatever kind of plan or non-plan lawmakers come up with, or if they fail to reach a deal. Dominic Chu is taking a look now at what the experts say to do with your money now. What are you finding, Dom?
Well, it's interesting because there's a debate in Washington, but there's a huge debate going on in the markets. There's an undercurrent. There's a lot of push and pull, a lot of buyers, a lot of sellers. Now, obviously, the last 2 days, the buyers have won. But there are 3 different schools of thought. One is maybe run for the hills, but not all the way. So they're saying, you know what, Miller Tabak's equity strategist Matt Maley says, hey, you know, take some of those profits. If you've made money in the market, why not sell some of that off and reap some of those benefits? Now, there's also those who say, hey, you know what? Stay bullish, all right? Stay right where you are and jump right in, buy more stocks. In fact, a pullback is huge. I was speaking to Alan Nuckman at Trading Advantage. He says If there's a pullback, I want to buy big blue chip names. Jump right in. He likes Coca-Cola. He likes Microsoft. So these big blue cap names that pay a dividend. But then there's those who say, you know what, stay put. Don't worry about it. It's not going to have a long-term effect, a lingering long-term effect. These guys in Washington are going to figure this out. So stay put. This should not affect your long-term portfolio plans. Sarat Sethi's a top-performing portfolio manager at Douglas C. Lane. That's what he says.
Are your sources telling you that this market is vulnerable to headline risk, most especially? Because if headlines come out over the weekend that the talks are stalemated or breaking down, and boy, we're going to have a lot of the Sunday talk shows focused on this, I would think Monday morning's open could be a rough one.
Well, so here's the thing. It can be a rough one to the upside or the downside.
Sure.
When we think downside, we say, hey, if there's no deal done, maybe the market sells off. But then you should have been positioning for that beforehand. But it could also be that on Sunday morning, we get a great grand bargain and everything goes higher. No matter what, you got to pick a path. And that's what traders have been doing over the course of the past week.
Do you think that this Monday partial holiday for, banks are closed, markets are open, some businesses are closed, could work for or against the markets? What did you hear?
Well, it's interesting because liquidity won't be a concern. Stock markets stay open, so that'll be interesting. We already had 2 good up days for the Dow. We'll see if it continues on Monday.
That'd be nice.
All right, Dom, have a great weekend.
And finally tonight, I think that we're going to wrap up. We have to say goodnight. That's Nightly Business Report for tonight. I'm Susie Garrett. For more on the stories we cover, join us on our website, nbr.com. Thanks for watching.
20 pounds of potatoes in a 10-pound bag tonight. Thanks for watching. I'm Tyler Mathisen. Have a great weekend. We'll see you here on Monday. Deal or no deal.
Nightly Business Report has been brought to you by
Street.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. No deal yet in Washington, but stocks soared again on Wall Street. Investors are optimistic that Congress and the White House are working on a compromise deal to extend the nation's borrowing limit and begin negotiating a resolution to reopen the government. The Dow surged 111 points, the Nasdaq rose 31, and the S&P added 10 points. But gold tumbled to a 3-month low as investors pulled out of the safe haven investment, even causing a short halt of trading. Pension experts say if there is a U.S. debt default, retirement savings accounts will lose $2 trillion. That's 20% of their value. And favorable weather and lots of rain are leading officials to forecast a record corn crop this year. Be sure to tune in to Nightly Business Report right here on your public television station.